Farmers have the best gig of any taxpayer in Canada. We can transfer all of our farm wealth to the next generation without tax, right? You screw that all up, though, if you have more than 10% of the value of your company being passive assets, right? And so,
give an example of that.
Let's not commingle farming assets with non-farming assets, right? So if you got a company, how are we setting up this farm? If we're doing a major acquisition, if we're bringing in a new family member, moving things to the next generation, how are we going to work through all of those different pieces, right?
Welcome to the Flaman Connect podcast, where we share real stories, experiences, and insights from people who know agriculture today and care where it's going in the future. Welcome to Flaman Connect. I'm your host, Trevor Grinde, along with Regan Kunz and Mitch Flaman. Our special guest today is Aaron Haight. He's an associate with MLT Aikens. Aaron assists clients with matters related to taxation, corporate commercial transactions, and estate planning. His active involvement in the ag industry allows him to provide unique perspectives in navigating the issues that arise with buying, growing, or selling a business, or transitioning to the next generation. Aaron frequently assists clients on matters relating to income tax, goods and services tax, provincial sales tax, share and asset purchases, shareholder and joint venture agreements, and estate planning. Aaron attended the School of Law at the University of Toronto. He also completed a Bachelor of Commerce at the University of Saskatchewan, majoring in finance. While pursuing his undergraduate studies, Aaron served as team captain for the Saskatoon Hilltops, winning national championships in 2010 and 2011. Welcome, Aaron.
Thanks for having me.
Okay, we're going to kick things off with a little game.
Oh.
I've got a couple of tax court cases. You see if you can determine what the judge decided in each case. Okay, ready? So the first one is a football player with the Edmonton Eskimos deducted $596 in expenses from his income as entertainment for clients. These expenses included footballs he threw into the stands after scoring touchdowns. Was he awarded that deduction or no? What do you think?
Absolutely.
Yeah.
I would say no, because they aren't his clients. They're the clients of the Edmonton Eskimos or Edmonton Elks.
I would agree. He's an employee of the Eskimos, so he shouldn't be able to deduct that.
Okay, so the court judge determined that he could only claim the expenses if they contributed towards his personal popularity for sponsorship purposes. In this case, they didn't, so the deduction was declined.
So if he was sponsored by Pepsi and he had a Pepsi sticker on that football and threw it in the stands,
then likely.
Yeah.
He needed to talk to his tax lawyer first.
Yeah, probably.
Okay, the next one. A taxpayer tried to deduct $7,000 in expenses paid to his 11 and 13-year-old sons. The taxpayer testified as to the exact duties performed by each son, including number of hours worked. He also testified that he paid his sons in kind rather than by way of check.
No.
No?
Do you not have to be a certain age in order to earn a salary or wage and be deducted off of a balance sheet?
I'm not the judge.
That's what I would ask.
Yeah, how old was this case?
Yeah, that's a good question. That didn't come up either. Yeah.
I don't think you'd take a run at it today, but I think there is a chance that it was allowed back then.
Yeah, it was. Yeah, so it was allowed by the judge.
Yep.
Define in kind, and I'll pose this to you.
Yeah, so I mean, it's just anything that you're giving property rather than just cash, right?
Okay.
So I'm gonna, contribute labor, for example, or something like that, right?
Cut the grass.
Yeah.
In kind.
I'm gonna feed my child. That's my in kind. The groceries are the in kind payment for the services he performed. It's interesting. The original, the very bedrock of tax principles in the Western common law system, which originally comes from Britain, and then comes to Canada, right, is something called the case, which was the Duke of Westminster. And it was all about how the Duke of Westminster wanted to be able to pay his gardener and to deduct the taxes, right, that he was paying to his gardener. And there was a set of rules back then that would have normally prevented those type of payments from being deductible, but he was able to structure his affairs in a way that ultimately the court found that he could deduct that, right? Really sympathetic figure. Everybody knows the Duke of Westminster needs to deduct whatever, the $500 he pays his gardener. But that's the foundational principle that all tax judges cite as saying taxpayers have the right to order their own affairs the way they want to. And if you get within the rules, then you get the deduction, right? More recently, and we I heard we don't talk about politics too much on this, but I mean, tax inevitably has a political dynamic to it.
Yeah.
More recently, there's been a bit of a shift, I think, in how government is approaching that and the CRA is approaching that, right? And there's a little bit less of give the taxpayer the benefit of the doubt. So it just means that people like me have to work a little harder to structure that accordingly. So,
Right.
Awesome.
A lot of that law is a matter of interpretation, though. So what you're saying is, over the course of time, the interpretation as being more in favor of the government than it has been of the taxpayer.
well, more that like tax court judges are very conservative in the sense of like if it doesn't fall within a specific rule in the act, the default is CRA, like good try, go back to Parliament, add a new rule to stop it, right? If you look at my Income Tax Act, there's a reason it's like 1,500 pages now, and it's because they keep stuffing new rules in there. What they've done recently, though, is they've started shifting it where they're putting in more, call it overarching principle type rules, a little bit more touchy-feely almost, that just like give more discretion to the CRA to say, we don't like what you're doing. We can't point to a specific rule that you're offside of, but we think you're just abusing the act as a whole. I struggle with that as a planner because it creates huge uncertainty for clients, right? And I think when you look at a tax-based system, at the end of the day, it is the government's job to put in laws that require us to pay our taxes, right? They shouldn't just be able to sit there 2 or 3 or 4 years after the fact when they've audited you and say, I don't like what you did there. I can't point to a specific rule, but I still think you owe us money, right? Like that's just not a really good way to run a country in my opinion.
There's an entire industry built on closing loopholes.
That is true. And finding new ones.
Yeah.
That's probably why the CRA is the largest group inside the Canadian government. They have almost 55,000 employees.
Whoa.
Yeah. Huge.
And once those laws are in place, they generally don't come off the docket, right? Like they're there.
Yeah. I mean, when you hear the talk about tax reform these days, like there is a lot of conversation about the fact that like the Income Tax Act has become almost unwieldy. I mean, I've been practicing tax law for, 6 years now, and there's just whole sections of the act that I never even got into, right? That I wouldn't even be comfortable touching. You talk like pension rules and all that sort of stuff, right? And so when your law gets that dense that not even a professional who works in it as their career can advise on the vast majority of the rules in it, you start sitting there and saying, maybe we need to simplify some things. You hear that conversation point, some leaders talking about, cutting through the red tape and making it simpler. The problem is it's a really hard thing to get across the line. Tax reform is not sexy. Re-editing the Income Tax Act probably isn't something that gets you elected. And when we work in a 4-year election cycle, it's all about what do we have now, right?
Yeah.
But it is a major thing that Canada, in terms of its overall productivity, needs to look at, because it does create real incentives when you look at investment in this country, right? And I see that in ag. If we're wanting to see value adds, investment here in this country, so that we're not just exporting everything, but we're doing more production stuff here. Tax is a big piece of that, right? And we saw that with the capital gains rules they've been on again, off again, right? And they were kind of proposed to increase the capital gains inclusion rate back in June of 24. Recently, of course, the Liberals came out and said they're going to push that off until 2026. That inclusion rate increase, though, moved our capital gains rates from about the middle of the G20 to the second highest. And if you don't think that would have an impact on foreign companies saying, hey, I can invest my capital anywhere in the world, we would be naive to think it doesn't, right? You're going to sit there and you're going to say, if I'm going to invest, build an asset that I'm going to sell, I pay the most tax in Canada, maybe I look somewhere else, right?
Yeah.
So I think tax reform, and I think because of things like the capital gains change, which really hit a lot of people, and I think, it was a big talk in farming world and stuff like that. People see it every day when they, sell an investment or something, all of a sudden, hey, I got to pay much more in tax. I think there's all of a sudden a moment in time here where, tax policy is actually a little bit more at the forefront than it maybe has been in some time.
Speaking of capital gains, while we're on the topic, after that announcement was made, have you seen a real influx or some reactionary moves within some of your clientele that's saying, okay, if it's 2026, we got to get on this now?
Yeah, so when the original announcement happened, I think the budget was released beginning of June 24, and they said we're going to have a June 25th implementation date, right? And it was a bit odd because normally when tax changes are implemented, either they're implemented like to align with a year end, so we're going to bring this in on January 1st of 25, or they're immediately effective on budget date. Because why would you announce it and then create a window for people to do a whole bunch of planning under the old rules in order to avoid the new rules? I don't know why they put that delayed implementation in, but because they did, like June of 24 was absolute insanity, right? I think there was, on my desk alone, I think I had like well over $100 million worth of transactions that came across that they were often like going to eventually be transactions. Somebody's eventually going to sell the business, but they wanted to do some pre-planning to allow themselves to pay tax at the lower rate, even if the sale was going to close later, right? So huge amount of, at the end of the day, professional fees paid by clients, a lot of busy work done. And then, of course, you get to this year, and now the Liberals are like, we're going to push it off to 26. You know, the two main runners in the liberal leadership race right now have both said they're going to drop the idea. It's creating, unfortunately, a lot of frustration for taxpayers because this is a trend with the current government of saying they're going to do something and then backing off on it and creating a bunch of busy work in the meantime. And why did we do that? So where we are, though, in 25, I mean, certainly we are encouraging clients to think about what do we need to do here in 26 or before 26 occurs, because at the end of the day, I don't think tax rates are going to come down. You know, even if your inclusion rate, even if that's not the particular tool, you know, increased personal tax rates or increased corporate tax rates, I think are definitely on the table. We've got a huge fiscal problem in Ottawa, and people need to be cognizant of that.
Have we seen that have an effect on land values as well since 2024? Do you think the two are correlated?
I mean, obviously there's a clear connection between the price you sell your land for and the tax you pay. Mm-hmm. I don't think it's depressing the market in any sense, though, right? Yeah. The way I see it, you know, and I have these conversations on our farm when I look to buy land and things, is it's a bit of a cherry on top. You know, it would be, hey, we've got a deal, a willing buyer, willing seller, we're almost there on price. Maybe there's some way we can come up with some tax savings that just gets it across the line, right? And if you can do that, there's a few different tools you can use to kind of structure things to make it a little more efficient. And so I think that ends up being kind of maybe the thing that gets it across the goal line, but it's usually not the starting point of like, oh, rates are going up, I'm just going to go sell right now, right? I think it's everything else in your life that drives you to sell, you know, based on where you're at in your personal trajectory.
Yep. What do you feel like are some of the biggest challenges or hurdles that producers face when looking at, and whether it's income tax or capital gains? What are some of the biggest hurdles just around that?
I mean, farmers are notorious for not wanting to spend money on advice, right? And it's fair, right? I tell this to my clients all the time. I say, I run a farm too. And if I feel like I'm paying a professional a bunch of money to just talk about a bunch of stuff that I don't really understand and I'm not sure how it relates to me, that seems like a bit of a waste, right? And of course, traditionally, you know, farming has been about, you know, put your head down, grind, work hard, you know, and hopefully you have some money left over at the end of the year. We would be naive, though, to not look at the last 15 years of value increases and say, listen, this has shifted, right? The last 15 years between a demographic shift, you know, there's all these statistics that get cited about the number of, you know, 60 to 7-year-olds that are going to retire in the next decade, right? And the greatest shift of value from one generation to the next. Couple that with the 10 to 15% increases in land value year over year for 15 years. And now you've got, I would honestly say in a lot of situations, a bit of a ticking time bomb that's related directly to transition of value and tax associated with that, right? And I find that for farmers who are often very good at fixing equipment, growing crop, marketing crop, that world, moving into the tax world, sitting in a lawyer's office, talking with accountants is often not something that they enjoy, right? And that's perfectly fine, right? Half the time I'm not that comfortable sitting in my own office, right? It's more fun to be in the tractor for sure.
Yeah.
But you need to find people who know how to give you good advice to help you navigate that, because putting it off and just kicking a can down the road is not making it better. It's just making it worse. We often say as lawyers that, you know, 95% of the time families will probably figure it out. Problem is the 5% where they don't are 100% of the cases that come into our office doors. Right. Mm-hmm. And when you see how it rips families apart and in some cases, you know, completely destabilizes businesses, it's a massive risk that has to be managed. It's no different than I have a crop marketing plan so that if, you know, whatever happens in tariff world and everything else, you know, I don't want that to completely destroy my profitability. It's got to be the same on the longer term planning for value and succession.
Do you have any tips around taxes, some do's or some don'ts, or some, aside from going and getting some professional advice maybe?
Yeah, I think there's a few layers you can kind of look at there. So, I mean, we're coming into tax season here, of course, which really people ask me often like, hey, it's tax season. You as a lawyer must be crazy busy. I actually say that tax season is slower for me because the accountants are super busy filing taxes, which means that, and the farmers are all off in Hawaii or Mexico or whatever. So, so it's actually a little bit less busy for me on the planning side. I mean, on a year-to-year basis, like your taxes kind of are what they are, right? You know, you got to take money out of your company, you got to pay some dividends, you know, think about it a little bit, make it consistent year over year. Don't take 500,000 out one year and then 50,000 the next year, you know. Have some plans for, is there ways that we can, say if we have other family members involved in the farm, is there ways that we can be splitting that income among, you know, a variety of different people? Those are some of the techniques that can kind of be used, but really your personal consumption is your personal consumption, right? I think it's the bigger ticket items when it comes to how are we setting up this farm? You know, if we're doing a major acquisition, if we're bringing in a new family member, moving things to the next generation, how are we going to work through all of those different pieces, right? And there are some things that I see over and over and over again. So one would be, let's not commingle farming assets with non-farming assets, right? So if you got a company, We saw this happen a lot in, say, 21 to 23, where prices were high, especially if guys are fairly well established, have their land paid off, they don't have a ton of expenses, they got a ton of extra revenue coming into their farm, right? So now you got a bunch of cash. It's two ways farmers use cash. Either they buy equipment or land, or they turn around and usually buy GICs because they're risk averse and they don't want to actually invest in something that's going to give them a big return. As soon as you have that extra cash sitting in your farming company, though, you've potentially created major issues for death tax if you were to pass away suddenly, right? Farmers have the best gig of any taxpayer in Canada. We can transfer all of our farm wealth to the next generation without tax, right? You screw that all up, though, if you have more than 10% of the value of your company being passive assets, right? And so,
give an example of that.
So passive assets would be anything that's a non-active farming asset. So, farmland, farm equipment's obvious.
Yeah.
Even working capital, I need a certain amount of cash every year in order to buy my inputs and that sort of stuff. But I saw, say, in Southeast Saskatchewan in 21, I was doing a bunch of planning with farms down there. Everywhere else was drought. They actually had some crop, right? They had 40 bushel durum that went to $20. They had 35 bushel canola that went to, or 35 bushel canola that went to $25. They had lentils that went to, 70 cents, all those things. All of a sudden now you had a farming company that had maybe, call it 5 million of land and equipment in it, and they've got 2 or 3 extra million of cash, right? Now all of a sudden 40% of the value of that company is extra cash that they don't plan to use the next year to put the crop in. And now, because you've gone across this 10% limit, we call it having a purified company, having at least 90% of your value being farming assets. If your company is not purified and mom and dad were, say, to pass away, in an accident or something like that, you've completely lost that ability to leave that property to the next generation. You will pay full tax on the value of that company.
So it's got to be under 10%, and then you can pass it you can transition wealth to the next generation. Call it tax-free.
Exactly. There's 2 sets of rules, right? There's the gains exemption that people know about. So currently the rules are every Canadian resident can have about $1 million of capital gains on farming property and get that tax-free. There's proposals to increase that to 1.25. It's still not law, though. It's still in that transitionary phase where we're going to see what happens. The other side is something called a farm rollover. So normally when somebody dies in Canada, they're treated as having disposed of all their property for fair market value, and you pay tax accordingly. Because we have this farm rollover rule, if I leave my farming property to a child or grandchild, I don't pay that death tax on that value. I get to leave. So usually when somebody files a tax return on death, you would claim some gains exemption up to that limit, and then the rest of the value would get rolled over or passed to the next generation without tax. And it's become an incredibly powerful tool. I'm seeing clients now, whereas people die, you're seeing, 10, 20, 50, 100 million of value sometimes moving from one generation to the next without tax. Whereas if you were running any other sort of business, you would have had to make a plan for how are we going to fund essentially a 20% tax hit on that 30 million of value.
Right.
And so it's such a good tool, and the planning is honestly fairly simple. You establish a holding company, make sure you get your assets over into your holding company. So you have a off-farm investment company and then your on-farm asset company. It's a very simple plan to set up. You have to, pay some attention to it over time, but the technique is so simple that we have to make sure we're dealing with that. And the reality is I would say probably at least half of the clients that come in my door are not in that situation. They do not have a purified farm company. They have their personal house in the farming company.
Yeah.
They've got investments in the farming company. They've got some other endeavor, some other business they're running in their farming company, right? And that can cause major issues. So